everyone. Welcome to Sparta's Unlocking Freight Demand webinar, the next step in shipping. My name is Felipe Elling Sherman. I'm the CEO of Sparta. And today we're obviously going to be talking mainly about freight demand side economics and the state of the freight market for MRs and VLCCs. And just as an intro, the freight market has historically always been focusing on the supply side economics and doing a phenomenal job at locating vessels, having a clear supply idea of where their vessels, how many vessels, where they are, when they're arriving, etc. But there's always been this missing link in terms of what is the demand for these vessels. So you get to the port and you don't really have an accurate picture of what will be the demand side for these vessels. So this is something that we've been working extremely hard on over the last year. And Michael Ryan, who's our guest today, has been spearheading this project. Welcome, Michael.
Thanks for today.
So Michael has been in the industry for more than 12 years now. Prior to Sparta, he was a freight trader at Trafigura on both the LPG and wet shipping desk. We also have a special guest today, Eric Broekhuysen. I'm trying to do it in the Dutch way. I don't know if I managed.
Perfect.
So, Eric, welcome.
Thank you. Thanks for having me.
Thank you so much for joining us. So, Eric is the head of tanker research and consulting at Poten, where he leads the team, a team providing valuable insights into global tanker markets, and with over 30 years of experience in the industry. So thanks, looking forward to hearing your thoughts and your ideas on the market. So let me just share a presentation. The idea is to explain a bit what is the status of the market right now, and then we'll have a panel discussion around what we think is going to happen over the next months, not on the short term, but midterm. But before, let me just share this slide. So here we go. So as I said, I basically introduced everyone. As you can see, I'm not an expert in these webinars. But before we start, just to give you a little bit of an update of who Sparta is, for those who don't know. So Sparta is a forecasting and intelligence company. So what does that mean? Is that we are not here to tell you what happened in the past. We're here to predict. We're here to anticipate market movements and to showcase opportunities, which means that we're not just here to provide raw data, but we actually analyze it, automate a lot of the calculations that you do on your daily basis so that you can then spot opportunities faster and have a better understanding of the market. Now, that has led us to, for example, in products, to be able to anticipate arbitrage opportunities. And by combining all of these arbitrage opportunities, we're now able to provide the freight element to it and give that demand side economic on the freight side. We basically cover all of the barrel in oil, from crude all the way down to gasoline. LPG is missing, hopefully early next year, and fuel oil is coming in a month's time. But anyway, this is not the purpose of the call today, just a little bit of background. So having said that, I'm going to pass along to Michael for him to introduce you what's the status of the MR market right now.
Thanks, Felipe. Thanks, Eric. So just to kick us off, I'm going to give a little bit of background of what's been happening over the last month in the Atlantic MR market, because it's been quite exciting recently. So what's been driving this action in the MR market? It's really been a combination of several interesting dynamics, all converging around the same time. So arb margins, and therefore cargo demand out of Northwest Europe, has been very poor over the last month or so. This caused TC2 rates to weaken in sympathy to try to help reopen the arbs. And then during the same period, the tonnage list supply doubled, mainly driven by lack of demand out of the region. All of this led to earnings dropping below 5K a day. And then over the course of the same period, the US Gulf Coast arbs began to look more and more attractive, with softening USGC rates helping to open several diesel arbs into Europe. these open diesel arbs and lack of demand in Europe were the driving force behind the skyrocketing TC14 rates over the last week or so. And at a high level, which you don't see this type of scenario too often, owners didn't want their MRs fixing TA, as once in Northwest Europe and having an open vessel in Northwest Europe, there's little to no cargo options for the owner's vessels at this point. In effect, this created an artificial MR supply constraint. And now, USGC TA earnings at over 30K a day, this has skyrocketed. It's basically doubled in the last 2 weeks. It's been quite amazing to watch. But at the same time, this has shut a lot of previously open arbs out of the US Gulf Coast. So on the next slide, you can see how a lot of the ballasters, they're all now heading towards the higher earnings in the US Gulf Coast. So the US Gulf Coast is attracting a lot of MR ballasters from all over the Atlantic, from Europe, Northwest Europe, from the Med, from WAF, and even your USEC cargoes are now heading south. So if you arrive in the next week or so, I think you'll be okay to still lock in these higher earnings. But for vessels that are, say, just now leaving the Med or leaving WAF, I really believe that you'll be arriving into a US Gulf Coast market where spot arbs have shut and your tonnage lists have lengthened quite aggressively. So with all of these cargoes coming through and with TC14 rates having moved up so much and shutting the arbs, I think it's going to be difficult to absorb this extra tonnage that's now pointing towards the Gulf. In addition, something that could help, at least over the next couple of weeks in a way, is with Hurricane Milton, a lot of your USAC ballasters are going to be delayed in their arrival back, say, towards Houston. And then equally, because of Hurricane Milton, a lot of the resupply from East Coast Mexico is also delayed. So this could help TC14 rates stay a little bit higher for longer, but eventually we're going to see the impact from some such high spot rates impacting the arbs.
Can I make a question? Well, maybe you're going to cover it now, but when we look at the TC2, it has been weak for some time now. All of this ballasting into the Gulf Coast, haven't you seen that phenomenon over, let's say over the last month or so?
Yeah. So it's been.
Just thinking, if that is a phenomenon that was happening already for a month, wouldn't you, anticipate a weaker market in TC14 or many more ships there going on there, or?
Yes. So it was a difficult call to have called TC14 to have spiked to 100 world scale points. It's been a really interesting dynamic in that the open diesel arbs out of US Gulf Coast, so they were open back in September, and you can actually see this. I've included a few. So on this slide, you can see Houston to Barcelona diesel on 27th of September, open by $1.25. Similar story, Houston to Rotterdam diesel, etc. So you had a bit of arb demand out of the US Gulf Coast. Tonnage lists looked okay. Some ships were ballasting into the US Gulf Coast, but nothing crazy at this point. But what actually happened was, because the arbs out of ARA over the last month have been so firmly shut and so awful, it caused tonnage lists to almost double because there were just no incremental arb demand cargoes. And with that tonnage list doubling, it caused the TCE, so your earnings per day out of the region, to drop below 5K a day. So in a long-winded way, what has happened is owners don't want to fix their vessel to go TA, transatlantic, to end up in ARA. So it's a combined effect of US Gulf Coast diesel arbs opened, which is great. You now have a demand driver, but that exact route is the route that owners don't want to do. So you have your diesel product traders wanting to fix a cargo because they took advantage of the open arb. They now need to fulfill it and send it to ARA, but your owners all of a sudden are digging their heels in and saying, no, we don't want our vessels to end up in this weak region.
Okay, understood. So one of the reasons again for TC14 to spike was also linked to the TC2 being so weak, essentially. Okay.
Exactly, and it's not always easy to see that in the lead up to it, but by looking at the forward ARBs, like back in say middle of September, if you had been looking at the ARBs out of ARA for TC2, everything was slammed shut, and the tonnage list kept incrementally increasing, making rates fall and earnings less attractive. So in a way, you could try and predict this sort of thing because there's such a strong dynamic between the two Atlantic regions.
Excellent. So thanks.
One other thing to just share basis what the ARBs have been doing is these lower TC2 rates, it's starting to make the region look more attractive basis demand. Because TC2 has weakened so much, it's actually starting to reopen some of these ARBs, which is good for Northwest Europe.
Well, it's definitely the case. I mean, I can tell you already in gasoline, we were talking about it this morning, that ARA is now, competitive into places like Mexico. I wouldn't say wide open, but it's definitely competitive, which tends to be a very strong indicator that either ARA is too cheap or that Gulf Coast is too expensive, or maybe both. But we definitely see that ARA is the cheapest source of supply into LATAM and now even Mexico. So that definitely will have an impact on the TC2 on the short term. Yeah.
Exactly. It's by looking at the ARBs in this case, you can really tell that the region has started to bottom. It was not as clear, say, 6 weeks ago, but each week that we've progressed and freight rates have weakened further, you can see this slow sort of bottoming of ARBs as well. And ARBs generally are a forward indicator of freight demand. One other very clear example of what we're talking about right now is what you're looking at here is your New York to Rotterdam diesel ARB. It's a very common backhaul cargo to ARA. 2 weeks ago, this backhaul ARB was in the money by $4.25. Now it's shut firmly by close to $15. So with this backhaul closed, it results in even more MRs ballasting south. So normally this would help to resupply the tonnage list in Northwest Europe, which in effect is bearish rates because more ships are arriving. But what it's done is the TC14 move, it's moving even more vessels down into the US Gulf Coast.
Okay.
It's a further bullish sign that TC2 rates have really started to bottom. It's also a sign that TC14 really can't move up any higher because all of the major ARBs are now shut. So what does all of this information mean and this current landscape? In short, we need to monitor both demand as well as supply because regional cargo demand is weakening in the US Gulf Coast and strengthening in Northwest Europe, while at the same time, supply is shifting towards the US Gulf Coast and away from Northwest Europe. So it's a doubly bearish signal for the US Gulf Coast and a doubly bullish signal for Northwest Europe. So as the slide says, what's the trade here? On the physical front, I would try to position my MRs to load out of Northwest Europe later this month, early November, as earnings should definitely rebound. And then equally on the paper side, which is always very quick to reprice, I believe there's still an opportunity to trade the spread between TC14 and TC2. In particular, I think there's upside for the TC2 rates. And with that, I'd like to open up the discussion to all of us and go further into what we see for the Atlantic MR trade going into next year.
Yeah, thank you for that. So that's actually the point. I would like to include Eric in the conversation, but the idea now is to move away from the very spot market and start thinking about what will happen next year. There's two main drivers. Well, two events is Dos Bocas refinery and Dangote. And the timing of it is debatable, but the impact is unquestionable. It's going to happen, and the main question here is what will be the impact on not only on the cargo side but obviously on the freight side. How is the dynamic on MR is going to be in the Atlantic? as they ramp up gasoline exports. How do you see that demand change happening, Michael?
So the goal of Dos Bocas and Dangote, and Eric, chime in whenever you want on this front, is currently they're supplying domestic markets. But the end goal, as we get deeper into 2025, is that they want to get to an export level where they're exporting gasoline to the major consuming regions of the Atlantic, correct?
Yes, I think that's definitely correct for Dangote. I think Dos Bocas is, I think, more focused on supplying domestic demand or satisfying domestic demand. The U.S. exports a lot of gasoline to Mexico. I think Mexico is by far the biggest gasoline customer of the U.S. in the region of 250, 300,000 barrels a day. And I think Mexico wants to be more self-sufficient on the product front. So what happens is they want to consume more of their own crude rather than export the crude, and then they want to provide more gasoline to domestic customers. And Dos Bocas is a sort of a signature big project for the Mexican government, has been under construction for a very long time. It's still not really operational. It's one of these refineries that is like, it will start next week, and then next week it will start next week. There have been a lot of problems, but eventually you would think they will start producing meaningful volumes of gasoline, and then that will back out some of the gasoline from the US Gulf Coast. So that will probably have to find another home. And that's going to be interesting to see where that might be. And then, so if you have another 100,000 barrels a day, 150,000 barrels a day of gasoline coming out of the Gulf that used to go to Mexico, and then where is it going to go? And
what's the impact on ton mile as well? Just because
ton miles is going to be quite significant, because it's only like a little more than a week round trip from the Gulf to Mexico, and anywhere else is going to be much further away. So it's a very close destination for the US Gulf refiners. So definitely wherever those barrels will go, assuming they will go, it will be much further away and will have a positive impact on ton mile demand. And then the Dangote refinery is actually a different story with maybe even bigger impact, because Nigeria has been a large crude oil producer. Their refineries have been in pretty bad shape for many years. So that's why this private person, Mr. Dangote, decided to build a very large refinery in Nigeria, taking advantage of domestic crude supply and also seeing an opportunity to provide the domestic market with much needed products, because West Africa in general and Nigeria in particular, they have been importing a lot of products from all over the place. But primarily, I think Europe was the main supplier of like gasoline into Nigeria. So in a way, against all odds, this refinery actually was built. It's operational. It's starting to ramp up gasoline, probably going to be more into next year when they start to produce meaningful volumes. But it's a 650,000 barrel a day refinery. Once it's fully operational, it could produce north of 300,000 barrels a day of gasoline. Nigeria and the surrounding countries, there is no demand for that kind of volume. So the chances are, as you alluded to, that they will start exporting gasoline as well. And then the question is, where is that going to go? it's going to be
Yeah.
good quality, high spec gasoline. So they will be able to sell it in Europe or in the States. The spec will be good enough. But we were just talking about the Bocas. You see overall gasoline demand with the increase of electric vehicles, gasoline demand is sort of declining in some areas and not growing in others. So I think the gasoline market in the Atlantic Basin is going to be quite long in the next couple of years. So you have these two big refineries coming on stream. Demand is not growing that quickly. But on the shipping side, that is not always a bad thing, because the stuff has to go. And as you mentioned, the arbitrage will, the windows will open in different places than maybe they used to, but
It could change the routes quite substantially.
I would
Because
venture that it probably will move, but it might move to different places, and it might actually increase ton-mile demand
No,
in the Atlantic Basin because of longer routes.
no, one thing is for sure is that, you will have a very highly competitive market in LATAM for both Gulf Coast barrels and ARA barrels, even Dangote barrels at some point, maybe not. Maybe that is more focused into cleaner markets. But so that's definitely one, I would say, one of potential conclusions there. But when you think about where is the gasoline from ARA going to go, one of the key potential outlets is going to be east of Suez, which is not so much an MR market, but it's much more
Yeah.
of a one or larger vessels. So that's going to be an impact as well. Do you see the same thing?
That could happen, definitely. And I think I think not all gas. You're probably much better equipped to talk about it than I am, but not all gasoline is the same, right? There's high quality and lower quality, and there's some of the product that came from Europe that was going to West Africa might have not been the best quality product. So Latin America might be a good market for that initially, and then the higher quality stuff definitely could go east of Suez. On the other hand, there have been significant refining capacity built in the Middle East, and they're still building a lot in Asia, obviously. So that's probably a market that is also getting increasingly competitive. And when those Bocas eventually starts up and produce meaningful volumes, maybe U.S. gasoline will also end up competing in that market. And well, Europe is probably going to go east through maybe eventually through the Suez Canal again, but maybe at the moment it has to go around the Cape, adding to ton-mile demand and really making it more likely that they will use large vessels rather than small vessels. And
So-
the U.S. Gulf exports may go through the Panama Canal, so then they might be able to sell more product on the West Coast of South America, for example. And it's already a big market for the US, but maybe there's more opportunities there or the West Coast. Yeah.
This year, you did see a lot of gasoline cargoes moving from Singapore, Far East into the West Coast, Mexico. That could be one of the shorts that you take over, definitely. But one of the questions I wanted to ask is, and Michael, we were talking about this, is that this potential gasoline glut, do you think is going to be a glut for MRs as well? Or, how do you see that happening based on what we just said about the flows? Yeah.
It's a good and tough question, because I also feel like this change in flows will change some of the classic Atlantic triangulation earnings. And what I mean by that is normally out of the US Gulf Coast, you carry a cargo of diesel, you end up in ARA and you carry a cargo of gasoline from ARA to New York. And then you have a decision to make to either ballast south or ballast back east or carry a backhaul of diesel. If ARA is not exporting as many gasoline barrels to the US because, for example, Dangote is, And instead, ARA is carrying barrels down to southern East Coast, LATAM, into, say, Santos, Brazil, or down into La Plata, Buenos Aires area. It's an interesting dynamic in the shift of flows that could impact the classic triangulation, but actually result in a higher ton mile and better employment of MRs because the route becomes longer. So it'll be very interesting because net, the MR market in the Atlantic is so used to triangulated earnings. I think they're, over the course of next year, people are going to have to get more used to looking at things as in, okay, if I discharge in East Coast Brazil or outside Buenos Aires, what do I then do with my vessel? Because now you're not ballasting just south from New York and down to the US Gulf Coast or something. You're now having to make a decision. Do I ballast back east, say to Dangote, or do I ballast back into the US Gulf Coast? So my hope generally is that because of increased glut of gasoline, if it does cause an increase glut of MRs, that this ton mile change actually absorbs some of them.
So, I mean, it's that new dynamic where you have a new hub, admittedly much smaller than ARA or Gulf Coast, but you now have a new option in your book. So that will create a new dynamic, and you need to have an understanding of the relative competitiveness between the two existing hubs and this new third one. But ultimately, you're going to have, in this environment, and we've seen this time and again, where you have more competition for the same shorts. That dynamic of the price action will be moving from one area to the next very quickly. Sometimes Gulf Coast will be the main supplier of choice, and then maybe 2 weeks later it's going to be ARA, and it's going to be flipping all the time. So in order to attract those shorts and therefore the demand for vessels, so having a very good understanding for the demand side economics is going to be paramount, no?
100%. You're going to want to look at what the forward arbs look like, how different arb routes are landing versus each other, because that will also tell you. So if you end up in Buenos Aires, you need to know what arbs look like next month out of Dangote and out of ARA and out of the US Gulf Coast, because now you have a big decision to make on where you ballast back towards. And that decision will carry either a lot higher earnings or a lot lower earnings basis where you decide to ballast. I think the stakes will become a bit higher.
Excellent. Well, I'm also conscious of time. Let's move on to VLCCs, if that's okay, unless you want to add something, Nora, or no?
Well, one last thing, Eric, something that you and I were talking about a little bit is just how if these flows change and if this triangulation changes, I think the more integrated traders and oil majors could still benefit from this triangulation because they have more embedded shorts and whatnot. And just versus that, your more independents or your owners might struggle because they don't have as many options for the end discharge region.
Yeah,
so
I agree with that. So it's the market, the transatlantic market, the triangulation market used to be pretty balanced some years ago. That's not the case anymore already, and it's probably going to get worse. Where it used to be diesel to Europe, gasoline back to the States, and it was a pretty balanced trade. And it was very efficient, a very efficient use of MRs. So I think that the balance is gone, and I think also that will mean that the employment of MRs is going to be less efficient and will create more ton mile demand just because of that.
Yeah, and more opportunities.
Go ahead, sorry.
I was just going to say also that inefficiency should create more opportunities if you're able to take advantage of them. And again, I think by looking at forward arbs, it'll be a very good leading indicator for freight.
That's the thing, is that the opportunity can also be a massive risk. If you have this inefficiency, you can end up naked in a very horrible situation like we're seeing right now, where TC earnings are below 5K and above 25K. You can either sit on a locker, we're going to talk about lottery tickets in a second, or you can be down, and not having that integrated triangulation that you were mentioning leaves you exposed, and it is becoming more and more important to have that visibility of what are my opportunities going forward.
Exactly.
But let's move on to VLCC. So let me share again the slides. Eric, the main topic of discussion on VLCCs is obviously the cleanups, and we've seen a lot of them over this year, starting to slow down. Can you tell us more about what you have seen this summer and what you're seeing going forward?
Yeah, so as the chart shows, there has been, this is showing 2024, that we have seen quite a few VLCCs and Suezmaxes, large crude oil tankers that usually would not be employed in the product market. They have cleaned up and have been utilized to move product mainly from the Far East into the Atlantic basin. And the reason for that is there's a number of reasons for that. One, so obviously, if you can, traders will always use the biggest ship possible because that gives you the best economy of scale. However, that has been amplified now by the fact that the clean market has been very strong. Part of that was after the Russian invasion of Ukraine. It has upended a lot of trade flows and created a strength for clean tankers. And secondly, was the conflict in the Middle East, where it became very dangerous to traverse through the Red Sea and use the Suez Canal because of the Houthi attacks on commercial shipping. So what that did is that a lot of the trade routes lengthened because movements from the Pacific into the Atlantic couldn't use the shortcut through the Suez Canal, so they had to go around the Cape of Good Hope. And that means that people wanted to use LR1s and LR2s, Panamax and Aframax size product carriers increasingly. And those ships became so expensive that traders started to think, oh, maybe we can actually clean up even larger ships, Suezmaxes and VLCCs, had to use them for at least one-way product movements from the east to the west. In the past, this is not something that has happened. It has happened before. Let me put it that way. It's not unusual, but in the past, these were new building ships. So these were VLCCs and Suezmaxes came out of the shipyard in China or Korea. They had not yet loaded a dirty cargo or crude or fuel or cargo. So they were clean and they could be used for a clean product move into the Atlantic. And a lot of these ships, they were going to want to position themselves into the Atlantic anyway. So that was a benefit. Now we have seen ships that have been trading in dirty for a while. They have been cleaned up, and that is a much bigger project. Cleaning them up is expensive, takes time. So the reason this makes sense is the freight differential between large crude vessels, VLCCs in particular, and the larger clean ships. So clean ships, I explained, were doing really well. The VLCCs relatively underperformed on the dirty side, so that made this opportunity real. So we've seen that quite a few of these moves. What will happen going forward? Given the increased tension in the Middle East, and we're in the winter months, typically that's when the crude markets are coming back up. A seasonality shows crude markets improve over the winter time. So I expect that these cleanups will not happen as much over the next few months. There will be a pause. You talked about the lottery ticket. Obviously, if you're an owner of a VLCC and you see what is happening in the Middle East, you probably want to keep your ship available for a loading in the AG in anticipation or of the possibility that there could be a crisis which might spike freight rates. So freight rates for VLCCs out of the AG are probably in the low to mid 40s now, $1,000 a day. But any kind of conflict there could quickly spike that to upwards of $100,000 a day. And at that point, you don't want to be somewhere else cleaning up your VLCC potentially for a gasoline.
You don't want to be
cargo.
explaining to your boss why all of a sudden you're cleaning up your vessel and all of your competitors have just gone from earning 45K a day to earning 100K a day in an instant. I'm totally with you. I think the risk reward, even just from being able to explain that to management, is too hard of a sale at the moment.
Yeah. And one last point I forgot to mention is that, so while new building ships were used in the past, the reason we've seen more existing ships being cleaned up is that the order book for large tanker has been very low for delivery in 2024. 2024, only 2 VLCCs were delivered from the shipyard. So this opportunity to use the new buildings wasn't there this year. So if you wanted to use a VLCC for a clean cargo, you had to clean an existing ship rather than use new buildings. Just they weren't there.
That makes a lot of sense. Yeah.
The other reason as well, obviously, that you were mentioning before is OPEC increasing production. So you want to keep it as well on the dirty side of things, right?
Yeah. Yeah,
Excellent.
OPEC is going to increase by a couple 100,000 barrels a day in December. So these ships are now getting, if you get in a few weeks, they will get into that window. So exactly.
Excellent. Okay, so to summarize, I'm just again conscious of time, and I want to move on to the questions. Wrapping up everything that we've said today here, on the current state of the MR market, we've seen this exacerbation of the TC14 market rallying, mainly on the back of diesel arbs that were open, and then of course no one wanting to go and land into a very weak TC2 market. So that obviously created this double whammy. But now we're seeing the opposite, where all of the arbs from the Gulf Coast are shut down, whereas we're now seeing finally a bottoming of the TC2 market. On the sort of mid to long term, obviously, the timing would be very dependent, but this situation with those Bocas and Dangote will have quite a significant impact on the Atlantic basin, where you will have now a new hub where to locate your vessels, but also it will create either great opportunities or dramatic situations where there's going to be a lot of instability, and having a better understanding of the demand side will be quite critical. Obviously, we're talked about the VLCC cleanup, that, as Eric is saying, that you don't expect this to be a new trend for economical reasons, but also mainly because of the geopolitical tensions that we're seeing right now, that who in his right mind would, miss out on this potential opportunity right now.
Yeah.
We have a lot of questions here from the let me go one by one. But again, guys, please, if you have any questions, please put it on the comments. What is your opinion in terms of the company D'Amico International Shipping going forward in the MR market? A very specific question.
I don't have an active opinion on that. I don't. Eric, do you?
No, I think we should probably refrain from I'm talking about specific companies doing specific things. First of all, we're probably not intimately familiar with
exactly
why they did what they did, and I think
Sorry, I should have read the question in my mind before. No, it's not. It's not something we can comment on. No. Another more market-related question is what do we expect the ARA WAF gasoline trade to develop in terms of volume? Now, obviously, the answer seems to be that it's going to be less volume for sure. But as you said, Eric, as well, it's not the same gasoline. You might end up in a situation where, because Dangote, let's say when they're fully ramped up and they do produce a very clean gasoline, that arbitrage of product quality can be, and we didn't mention this before, but it can be quite a substantial game changer as well for MRs, where you end up in a situation where ARA continues to export to WAF, but then Dangote is now exporting more to locations like New York or South America, which would then, alter even more the triangulation that you were mentioning.
They could be playing the spread between the grades. You're right. ARA could still see barrels down to WAF in a certain grade, but then Dangote is actually exporting a higher grade into the US. It could dynamically develop like that for sure.
And honestly, when you look at the spread of price between the WAF gasoline and a clean gasoline, the price is quite substantial. It can easily compensate for additional freight or things like that. So I would not be surprised that maybe that is one of the end games here, and that Dangote becomes much more of a supply side. But then you have the political, the local decisions. If they change the gasoline spec in order to accommodate for Dangote spec, then that's a game over there. But
it would be tough to import a lot from ARA when Dangote is kind of there to help support the local business, well, the local market for better prices and whatnot. But we should still see some ARA barrels landing there.
Yeah. Another interesting question here is, which vessel class do you think has benefited the most from the geopolitical tensions that we're living right now?
I can take that one, or Eric. You too as well.
Go ahead. I'll chime in after you your comments. Yeah.
In my opinion, it's more the LR sizes rather than the MR sizes, and this is mainly due to LRs transiting the Cape. So with the shutting, the reduced number of vessels transiting the Suez Canal, I think this has benefited more the LR1s and LR2s because they're more likely to then transit via the Cape. What do you think, Eric?
Yeah. No, I think there are two. In a way, there's two events that has happened in the last couple of years. The Russian invasion of Ukraine, I think, has benefited probably MRs as well, because you had a lot of short haul moves of diesel from Russia to Europe that has disappeared, and Russia has to export it much further afield. So probably that has lengthened the average haul and created more demand for MRs. At the same time, Europe has had to figure out other sources of supply to replace the Russian products. So I think those things initially benefited probably MRs as much as the other sectors, but definitely the Middle East has been a boost for the larger ships because of the need to avoid the Suez Canal.
Yeah, makes sense.
The next question that we have is, can we expect Europe to continue to import diesel from the US? I mean, depends on the time frame of the question. I guess that if you're asking very short term,
right now, for this moment, I wouldn't expect to see very many incremental cargoes loading out of the US Gulf Coast carrying diesel to Europe, just because the incremental arb has been slammed shut. But I think the fundamental flow of diesel barrels will continue to gravitate towards Europe, in part because Europe just consumes a higher ratio of diesel versus gasoline compared to the US market.
No, and it's, in this context of geopolitical tension, if it continues to escalate, then the Gulf Coast will actually become your base load, for Europe. Whereas right now it's much more West Coast India AG, complemented heavily by Gulf Coast. But obviously this actually might change. Again, it's pure speculation. It depends on if it escalates or de-escalates. But on a medium-term basis, it's definitely going to be one of the key suppliers into Europe. That's for sure.
For sure.
Yeah.
For sure.
Do you agree, Eric, or any?
Yeah, no, I agree. I think, and definitely, I think this trade has been there for a long time. And the growth, I think, European diesel demand is not growing as quickly or is not as big as it used to be. But I think there's definitely a significant baseline demand, and the flow will continue.
More questions. If that's okay. I mean, we're normally supposed to finish now, but I'm happy to continue if that's okay with you, Eric.
Yeah, I'm available.
Okay, good man. Regarding TC2, where do you attribute its gradual softening during Q2? Let's start with that. What is your opinion on that?
So yeah, I'm just reading it as well. So gradual softening during 2024. So
is it because of the cleanups, VLCC cleanups heading into FOS or into WAF, and then obviously having an impact on MRs? Is it LR1 versus MRs? What do you think?
So Eric, we started to see the VLCC cleanups in early summer or so. And or
that's
maybe
when it really
earlier.
started to pick up. Yeah,
and I would expect that would have had somewhat of a material impact on your MR rates as summer went on. And I just remember off the top of my head, summer was quite awful for Atlantic clean earnings, a bit of a summer doldrums, if I remember correctly. But Eric, do you think that VLCCs played a material role in the MR's weakness, say out of TC2 over the last 6 months?
I think it was a contributing factor. I don't know if while it received quite a bit of publicity, I don't know if the volume of VLCCs going from Asia to Europe was such that it really fundamentally changed the Atlantic MR market. But it's obviously it was not like one VLCC a week that showed up in Europe. So it's but I think it was a contributing factor. These things are very difficult to dissect always. What are the? It's a combination of factors, which in a way what the question already indicated is a combination of factors which has contributed to that. It's probably demand in Europe, more supply from the Far East, the situation around the Middle East where it was using larger vessels was incentivized, so more volumes did show up.
True.
So
no, another contributing factor as well is on the gasoline side. Is historically you would always have a lot of demand for gasoline from ARA to New York in summer, and it would be a continuous demand. Now, two contributing factors. Well, two factors actually made that ARA was less economical into New York, specifically on a quality perspective, is the fact that you could now move naphtha on the pipeline in the US. So the gasoline is now more and more blended in New York rather than ARA. So instead of New York importing finished grades, they actually blend more in New York. That's one factor. The other one is that ARA had access to very good quality naphtha from Russia that no longer can go there. So as a consequence, what we've seen this year and actually last year as well is that you didn't really have a lot of demand from ARA to New York, and that that could mean in some months it could mean 300,000 barrels extra of demand in summer And we didn't really see that this year at all. The ARB has been pretty much shut down all the time, except for some pockets of demand.
That's true. I remember seeing the naphtha ARB from ARA into New York open more frequently than the actual gasoline ARB going that same route. So as you say, potentially for blending in the New York market then.
Yeah, definitely was the case. Another question is, how do you explain the spike in TD25, and do you see it continuing?
So, Felipe, you and I, we were talking on the podcast recently. The TD25 spike, I don't know if I can fully explain it, but interestingly or coincidentally, TD25 has followed TC14 in its price action. If you were to take TD25 on a chart and overlay TC14, they look quite similar. I'm not saying that there's a real causation there, but it's just interesting. Now, from a DPP sort of frame of looking at things, I potentially could think that perhaps more Libya barrels are coming out. So fewer Aframaxes are ballasting back into the US Gulf Coast. Maybe they're then picking up barrels out of Libya, and that has reduced some of the tonnage. So therefore prices have gone up. But other than that, I don't have a super strong view on what TD25, the causation is. Eric, anything on your side on that?
No, I just struggle to explain that as well.
Yeah.
Maybe like one last question here. Interesting question. Do you think that the freight rates are currently overvalued in the sense that in terms of product movement, meaning that there's been apparently from the question, there's less products moving across different regions, and that the premium is much more driven by longer journeys or geopolitical premiums? Is that, let's unpack that. Do you think that there is less, cross-regional ARBs happening now versus in the past? I don't really think so, but
I would say that I think the geopolitical tensions have definitely put a base in, especially for your LRs. Like if we were to graph it, I would kind of expect to see a higher lowest case earnings per day than say several years ago, just because this longer ton mile from all the geopolitical tension has caused this higher base. So I think there is that sort of effect in your LR earnings. From an ARB perspective or a volume perspective, I don't think we've seen too big of a drop off in volumes to say that volumes still aren't a material driver in the LR market.
Yeah, I agree with that. I think there is the inefficiencies that have been created by the various conflicts in the world and the sanctions that materialized thereafter. It probably has lifted base demand, as you say, Michael. I think that is true. If the Russian invasion would have never happened, I think there would be a lot more efficiencies in the Atlantic market, for example. So that has helped. And on the and the LRs definitely in the Middle East have pushed up base demand as well. But to Felipe's point, I think if those events wouldn't have happened, maybe volumes would have been different, and the trades that are now in a way suppressed would have been much bigger than they are at the moment. So it's very difficult to say, okay, this without that the market would be a couple of $1,000s a day lower. That's hard to say. I think the trades would be different. And as we just discussed on the Atlantic Basin, different trades can lead to more ton miles and actually higher freight rates. Even though
we discussed it
it's
this morning. We had a chat internally, and what we were noticing is that obviously when you look at flat price, it has moved dramatically. But when you look at spreads, cracks, or even physical premiums, they have not moved in line. Physical premiums of crude were lower, the physical premiums of diesel were lower, and spreads of gasoline and cracks moved up a little bit, but nothing dramatic. And what we did notice is that the physical, everyone is buying futures as a hedge of any potential geopolitical escalation, but the physical market is still dominating the spot, and we're seeing that this has an impact on maybe east-west or things like that, which open up new arbs, and it creates more physical opportunities. We're now seeing ARA open both on east of Suez and maybe as well in LATAM. So I still think that the physical reality is driving or will continue to drive the economics of ships, and as Michael was mentioning, the TC2, TC14 idea and things like that.
Yeah.
Okay, well, look, we're out of time. I think there were more questions, but we'll get back to you on those questions. But thank you very much, Eric. It's been a pleasure exchanging ideas with you. Hopefully, we can have you back again. Michael,
Sure.
Again, pleasure. Thanks so much for organizing all of this, and congrats on the launch of the freight tool, which we launched today, actually. But yeah, thank you very much, guys.
Okay,
Yeah, thank you.
My pleasure.
And special
Thank you.
thanks, Eric. Much appreciated. And thank you, Felipe.